Hey, what's going on, guys? This is Blood Phantom 81. Welcome back to my channel. I hope you're having a great day or a great night whenever you're watching this. I wanted to make this video because I was very excited about two investments that I made recently. I actually added these to my dividend growth portfolio, also known as my defensive portfolio. So I actually made a video talking about my defensive portfolio. So if you guys want to check that video out, then go ahead and go to my channel and watch it after this one. But yeah. So those two investments are A.O. Smith and Simon Property Group. So I'll talk about A.O. Smith first, actually. I think these are both great companies, and I'll definitely compare and contrast some of the financials and technicals. But I highly recommend both of them, actually, and here's why. So I'll start with A.O. Smith. So A.O. Smith isn't actually isn't a popular company. And I think just recently, maybe last year or sometime in the last 2 years, they joined the Dividend Aristocrat group. So they've consecutively increased their dividends for about 25 years now, every single year. Excuse me, guys, I'm getting over a cold. So, congrats to them. And right now, I think their starting yield is around 2%. So even though A.O. Smith just joined the Dividend Aristocrat group, they're actually pretty old as a company. I think they were founded in the late 1800s. And at one point during World War I, they were the largest bomb manufacturer. So kind of an odd thing to have on your resume as a company. But these days, they're more of an industrial and utilities type company. So let's go ahead and take a look at the kind of products that they make. So yes, technically they are an industrial products type company, but the products that they make all appeal to utilities. Now, what that means is they don't earn money in the same way that a lot of utility companies earn money, which is, gas, water, electricity, and that kind of thing. But they make the products that make that kind of thing possible. And I do think there's kind of a bit of a correlation between the two. So in a sense, I do like the kind of safety that a lot of utilities have. So right now they specialize in gas lines and electric water heaters, but that includes commercial and residential properties. So why don't I go ahead and read this short description. So A.O. Smith Corporation manufactures and markets comprehensive lines of residential and commercial gas tankless, and electric water heaters. Also, fun fact, for commercial gas, around the 2000s, they actually acquired the company that was the exclusive provider of water heating to Lowe's. Like Lowe's, the actual company, the hardware company. They purchased the company that was the exclusive water heater company to Lowe's. I think that's pretty cool. And actually, in the 2000s, they made about 5 or 6 major acquisitions. Some of them had to do with electric water heating. Some of them had to do with automotive parts and things like that. And in 2009, they entered the water purification industry, which is actually pretty interesting. I was mostly reading up on their Wikipedia, so you guys can check this out. I'll link it in the description below if you guys want to read more about their acquisitions. But when I read all the acquisitions they've made over the last kind of 15 to 20 years, to me, this doesn't sound like a company that's done growing. And this sounds like a company that's going to reinvest their earnings into expanding and getting into more industries. I do like that AOS is not just going to make kind of the same products over and over again. They actually have a history of making more efficient and, well, I guess, energy efficient type products, which I think is awesome. So yeah, all around, I do kind of like the safety of the products they make. I've already mentioned that. Let's go ahead and take a look at their dividend yield. So once again, its starting yield is about 2.06%. But one thing I really want to highlight is how quickly the yield grows. That's the first thing that stood out to me for AOS. So actually, just recently, this quarter, they had a dividend increase. Their previous dividend was about 18 cents per share. And so now they're paying a dividend yield of about 22 cents per share. So that's an increase of 22%. And the year before that, it was even more. It was about 28% the year before that. The year before that, it wasn't as high. It was around maybe 16%, which is still so much higher than a lot of these other dividend aristocrats. And they had a stock split here on October 5th, 2016. So that's why the numbers look like they're smaller or skewed. But that's just the split because of the share price. But now let's answer the question, how does AOS manage, or I guess what's the motivation to increase your dividends so quickly? That usually happens with stocks that have a share price that accelerates very quickly. So clearly a high flyer since 2016. And by the way, I love to look at how much stocks increase around the summer of 2016, because this is when the entire market had kind of like a 1 year bear market, 1 year consolidation. The S&P 500 reflects that, obviously. So when you take a company like that, I want to see how much they grew since then. I always think that's a really good measure. So since then, AOS has increased by about 125%. So in order to make their shares more attractive, they're going to have to increase their dividends rather quickly, because the share price grows quickly and they don't want the yield to fall below a certain amount. So 125% increase, that's pretty high. As it stands right now, their 52-week high was around maybe $68, but they've had a decrease of pretty close to 40%. Let's just round it out and say 40% of a decrease. So 40% off of the 52-week highs. Now, that is more than just your average correction. So I can definitely see why a lot of people would be worried. I do remember when AOS was around here, the dividend yield was only around like 1%. So the starting yield is 2.06%, which is something that you don't see with this company. And going back to the size of this correction, once again, I do understand if that's not your cup of tea, you might be worried. You might be thinking that something's wrong with AOS. For reference, in the summer of 2016, AOS lost around maybe 23% of its value. And also for reference, let's go ahead and take a look at the 2008 recession. So from the high of 2008 is around $8 a share, and the low was around $3.50 a share. So that's a decrease of about close to 60%. So you're telling me that in a recession, AOS lost 60% of its value, but here in 2018, since January, we already lost 40% of its value, and it doesn't look like a bottom is in. So one thing I'll note is I always look at the 200-week moving average. I always consider this a long-term area of support, kind of like a line in the sand. Not as crucial as something like the 50 or the 100-month moving average. So from a very, very long-term perspective, AOS is still kind of still in an uptrend technically. But what this tells me is the bottom doesn't look like it's in. So I understand if people think that something's kind of wrong with AOS, if this is much too deep of a correction in order to get into it, that's fine. But I still think that the dividend yield will continue to increase at a rapid rate. And I'm fine with averaging down on AOS, even if it goes a little bit lower. So just some highlights from the financials. Payout ratio of about 34%, which is pretty decent. Nothing much more that I have to add. I think that's pretty average. Another thing that I think a lot of investors won't like is the profit margin. So it's only about 10%, which is actually not that bad when you scale it to other industrial stocks. Something like 3M actually has a profit margin of about 13%, which isn't actually that much higher. 3M is one of the better companies in terms of that. So I can also see why investors wouldn't like that. But one thing I will note is the amount of revenue that they've made, or gross revenue that they've made. Gross profit that they've made every single year has increased by at least 10%. And I know that gross profit is such a high level kind of metric to look at. I know it's like, you look at this thing like gross profit, you look at kind of liabilities, you look at things like operating expenses, and it's just a huge ladder before you get to the thing that you really care about. But I still like looking at total gross profit, just because it gives kind of a good story of like are how fruitful are their acquisitions? Um, so that's something that I like to see. The beta is also a little bit more volatile than most investors would expect. 1.45, something like Netflix is about 1.8. And for those of you that don't know what beta is, beta is basically like it's a way to determine how volatile a stock is. We usually compare it to 1. So 1.0 would be like the market average. So AOS is definitely more volatile than the market average, as you guys can see over the last 8 months or so. So I literally just listed a whole bunch of negative things that investors could say about AOS. I still like it, and the thing is, I don't know when else we're going to get a starting yield of about 2%. So AOS I love for the long term, and I love for the dividend growth. Starting yield is not the whole story. Okay, if a starting yield on a stock is like 1% or something, or 1.5%, don't just dismiss it because it's probably a fast growing stock, especially if it's like an aristocrat or something like that. Just for reference, something like Apple, which is one of the fastest growing companies right now, has a starting yield of about 1.7%, clearly took a hit. And if we take a look at how fast they're growing their dividend, from the last year, or for the last dividend increase, the dividend increase was about 15.8%, where if you guys remember, AOS's was around 25%. So it can definitely hang with some of the faster growing stocks. I know that Apple's goal isn't to grow their dividend really quickly, but that's just for reference. So it's hard to find a combination of fast dividend growth and a pretty solid starting yield, and something that has a history of fast capital appreciation. So I like AOS for the long term. I understand there's a lot of reasons for why people wouldn't like AOS, but I'm just ignoring all that. I just added it to my defensive portfolio. So yeah, that's about it that I want to talk about with AOS. Next stock that I want to talk about today is Simon Property Group. So one thing I want to highlight, the first thing that jumps out of me is beta is only 0.43, which is obviously way below the 1.0 kind of metric that I mentioned earlier. So the stock is not very volatile. However, it's currently on a pretty good discount. So I didn't get into this company here at around 150, 148, when the share price was clearly really beaten down. But I am getting in now. So there's still about a 20% discount off of the 52-week highs. One of the things you'll note is it's hard to pinpoint when Simon Property Group actually has a tough time in terms of share price. So here was the 1 year kind of bear market that I mentioned. Actually, see, that's something that I just mentioned. It's hard to pinpoint when the 1 year bear market happened, because this was the summer of 2015 to the summer of 2016 that I mentioned. SPG looks like nothing really happened to it. However, here around August 2016, when the rest of the stock market was rallying, SPG kind of took a dive over the next year. So I am a firm believer that this kind of 1 year, 1.5 year period of consolidation is about to be over. I do think we're on the way back to 52-week highs, and that's just me from a technical perspective. If we look at the fib ratio of this, found support here at the 0.382 retracement, which is kind of ideal for a third wave. So I do think that we're going to head back to all-time highs in the near future, and I just couldn't resist it right now. The other thing I want to note is two things about SPG. Number one, starting yield is 4.27%. Now, you might be thinking, okay, if the starting yield is already high, is already over 4%, it probably doesn't increase its dividend by that much. However, SPG is one of the few stocks that actually increase their dividends multiple times a year. So I want to show you guys something pretty crazy, actually. So here in 2015, starting yield was about 140, right? This was Q1, so this was around February 10th, 2015. They paid out $1.40 a share. The next quarter, they paid out $1.50 a share. Next quarter, they paid $1.55 per share. And the next quarter, they increased by another 5 cents, $1.60 a share. So throughout that year, the increase was about 14%. And that's actually like not a far-fetched goal for SPG. I think you can expect a dividend increase of around maybe 8% on average with something like SPG, even going forward, and be prepared to see those dividend increases as the year goes on. So it compounds a little bit quicker than something else that only increases after about a year. And I just realized I didn't talk about what SPG actually is. So you'll find SPG. They're a REIT, by the way, which is a real estate kind of company. You'll find this company in a lot of low volatility funds. SPG is actually a holding in SPHD, which is another kind of low volatility ETF that I've made a video about. Definitely check out my SPHD video. I'll leave it in the description below if you guys want to check that out. But SPG is a REIT once again, and they're actually the second largest REIT in the United States. So that says something. This is kind of like a world-class REIT. They own about 207 properties, 107 traditional malls, 68 premium outlets, and 14 mill centers, which are kind of like hybrid kind of malls, 4 lifestyle centers, and 14 other retail properties. I think the rest is kind of irrelevant, but yeah, very, very large REIT. One thing I will mention is how well SPG is at making money. So the first thing I want to address is if it isn't to like the average investor, this is kind of not very attractive. And that's because 68 premium outlets, 107 traditional malls. You might be thinking like, well, people don't go to malls anymore. This doesn't feel like a very good long-term investment. And you might be right on that, but the numbers say differently. So one thing I want to point out is the profit margin. So this is huge, about a 41% profit margin for SPG. The revenue is also increasing. Where can I find that? So yeah, I will note, I will admit, even though that gross profit's increasing, the rate at which it's increasing is actually kind of flattening out. It's not, on the exponential kind of curve. It's kind of flattening out a little bit. That's kind of the only thing I would say I don't like about this. But once again, profit margin at around 41%, and return on equity of about 62%. That's super, super efficient. That's basically, for those of you that don't know what return on equity is, it's basically the amount of money that SPG is making relative to the shareholder investments. And that's based on an initial shareholder investment. So 62% is actually is great. And if you guys are looking at Yahoo Finance's kind of stats, you'll notice that the payout ratio is actually over 100%. But that's pretty common for a REIT, so don't be alarmed by that. So overall, SPG is something that I like, and I don't know how much longer this sale will last. Once again, I think they're about like 20% off of the 52-week high. So yeah, that about does it for this video talking about my defensive portfolio. I guess I should probably show my pie now. Give me 1 second. High savings, defensive. So yeah, so this pie is my defensive pie. I now have 22 holdings. I used to have 20 holdings, but now I have 22. Dividend yield of about 3.01%. So that actually didn't change, but as you guys can see, the 3-year growth is still pretty good. So yeah, very happy to be talking about these stocks. Let me know what you guys think of them. Yeah, hope you guys have a great day, and good luck investing, good luck trading and all that. Yeah, have a great holiday actually.